A few months ago, a close friend of mine spent $4,000 on a couple of electric bikes. A few weeks after this, her and I went shopping together to buy some necessities. And in this trip, she bought a few outfits that totaled to over $300. And she said, "It's okay. I just graduated as a nurse, and RNs make a lot of money." But the thing is, she doesn't start her job until the fall. Recently, she's wanted to move into a home for herself and her family. So she applied for a mortgage. And what she got offered made her upset and mad. My name is Lexi Campanilla. I watch my credit score daily now. I do my best to keep my credit score high, and I have studied a lot about credit and credit scores. My friend used credit cards to pay for her electric bikes and her outfits that were over $300. And I told her right away she has to pay it off as soon as she can. And she has to be responsible with her credit cards. Which meant she had to rethink the way she was spending her money, her credit. Looking at credit awareness and usage, your credit score matters so much. According to Lisa Bernardi in a 2021 Next Advisor article, credit scores affect your approval for credit cards, auto loans, mortgages, personal, and any other loans, and it affects the interest rate that goes with it. In a 2020 article by Jacqueline DeMarco from LendingTree, data shows that only 50% of credit card users actually check their score on a monthly basis. According to Megan Leonhardt in a CNBC 2019 article, 36% of students have over $1,000 in credit card debt already. TallyTech's Chris Scott mentions in 2021 that the reported average college student credit score is only at a 630. And a 630 score is in the fair category on a scale between poor, fair, good, very good, and excellent. While we focus the attention on the problem at hand and the need to change these problems, Wallet Hub data conducted by Bianca Peter in 2022 shows that the percentage of students who pay off their full credit card balance have gone down since 2015. Back in 2015, 63% of students were paying their full credit card balance. But in 2020, that 63% went down to 53%. Additionally, only 32% of college students just pay the minimum balance. Matt Schultz reported from a LendingTree survey in 2019 that 4 in 10 college students with credit cards made a late payment. Adopting an "I'll pay it later" attitude, forgetting about the bills, and not tracking spending or credit scores are common mistakes that a lot of college students make, according to a 2021 NerdWallet article by Lindsay Konsko. The issue with these is self-explanatory. It builds up debt slowly over time when bills are forgotten, and credit card purchases or charges aren't being added up. Being in college can be pretty busy, but it's important to remember your credit and bills. What ends up happening is that everything with credit reflects in your credit score. Credit reports during college year significantly sets up the student for their financial future. Jennifer White tells us in 2022 on Experian, one of the main credit bureaus, that any late payments will remain on your credit report for 7 years. Late payments are also a significant hit to a credit score. Credit history is the biggest factor to a credit score, and most people rely on lenders for a living. So a mortgage for a house, or an auto loan for a car, personal loans for emergencies. Libby Wells mentions in a 2022 article on Bankrate that lenders will not give good rates nor credit limits to people who have lower scores. So basically, the lower your credit score is, the higher interest rate and monthly payment you would get. For example, let's say someone's interested in a 30-year fixed mortgage loan for a house that's $300,000. If their credit score is between a 680 and a 699, the national APR would be 5.234%, with a monthly payment of $1,654. On top of the $300K house, excluding a down payment, they're paying $295,000 and $310 in interest. However, if their score was at a 630, the national college student average credit score, their APR would be up to 6.424% and a monthly payment of $1,881. And on top of the $300,000 house, they're paying an extra $377,244 in interest. Even though buying a house may not be on a college student's mind, it will be eventually, in most cases within 7 years after being in college. Now that we've looked at credit statistics and common activity for college students, it's important to avoid these common behaviors and instead keep a good high credit score and use it responsibly. Credit activity, especially in college, sets up a student's financial future. If my friend paid more attention to her credit and the way she was using her credit score would be higher, not as low as it is now, and she would have a better mortgage rate. If college students use credit cards more responsibly, if they paid their full balances or more than just the minimum payment, and if they pay them on time, they would have an improved credit score. Additionally, Louis De Nicola mentions in a 2021 Credit Karma article that keeping credit utilization less than 30% would be good for credit because it shows responsibility and that it's one of the most important factors that influence a credit score. Understandably, certain scenarios may prevent that. Life happens, and sometimes people won't have enough money to pay a full credit card bill for a month. But that's okay, as long as the minimum payment is made and it's not late. The price to pay is the credit card interest. Paying just the minimum doesn't hurt credit nearly as bad as it does missing a payment. Payment history is 35% of a credit score. And Alexandria White reports in a 2020 Lending Tree article that missing a payment to the point where it shows up to the credit bureaus can affect the score to drop 90 to 110 points. Now that we went over the solution to improving credit scores, let's look at how this would change young adults' lives. Let's say that my friend did not miss payments and actually thought about how much debt she was stacking up. If she used her credit more responsibly, she would have an improved credit score. If more students started using their credit responsibly, the average college student credit score would go up from 630. This would allow more young adults to obtain better APR rates from lenders. In other words, young adults would actually be able to have a chance at affordable lifestyle given monthly payments on a mortgage or on an auto loan. If college students' credit responsibility remains the way it is now, or if it declines, then the average college student credit score would still be at 630 or even lower, thus making it very hard for young adults to even qualify for a mortgage or other loans. And if they do, their monthly payments would be very high with high interest rates. After visualizing these scenarios of what the world would be like for college students and young adults in regard with credit usage and responsibility, let's look at what can be done to achieve the better credit scores. After my friend expressed her feelings about the low amount she was qualified for, I had a talk with her and suggested a few things to help her out. My first recommendation: set up automatic payments on your credit accounts. If this is not possible, then I suggest you figure out the dates of all the credit card due dates on someone's credit history. If possible, change those due dates to be on the same date. Some lenders, some banks let you do that. Change the credit card payment date due. Then, for each credit account, set 2 payment reminders. The first reminder should be 3 days before the actual due date. This is because some due dates fall on a weekend and they will not receive payment if it's made on the day of. So schedule the first reminder 3 days before. Schedule the second reminder on the day of to remind yourself if you have not made a payment yet. My second recommendation: pay as much as possible to further reduce the amount of debt owed. My third recommendation: make it a habit to check credit scores and account balances. Do it daily, weekly, bi-weekly, when you get paid. Credit Karma, it's a free app, and I put mine on the front page of my phone next to my bank apps because it's the first thing I'll see. Most bank apps show your FICO score, which is the score from Experian. They show it to you for free. Credit Karma is also free. I bank with WeQ and BECU, and I know they provide the FICO scores for free. If these steps are taken, it allows for late payments to not be missed. It reduces overall debt owed, which potentially lowers credit utilization to lower than 30%, and it allows for credit users to have a raised awareness of their credit activity and their score. I will leave you all with something that always reminds me of the importance of credit. It's the path to your future. It defines your financial future. Thus, it tells you what housing and auto budget you have. It tells you how much you most likely will have to pay in a month, your monthly bills. The lower your score is, the higher the bills, and no one wants that. So let's do our best to keep these scores high. Thank you.